Hello, this is Brett Rentmeester, President of WindRock Wealth Management. WindRock is a unique wealth management firm helping clients navigate an increasingly uncertain world by focusing on the macroeconomic big picture with an entrepreneurial mindset to finding investment opportunities. Today I'm joined by Alasdair MacLeod. Alasdair is the head of research at GoldMoney, a firm dedicated to helping clients own physical metals outside of the banking system. He is an expert in the gold and precious metals markets, but also a respected thought leader on many macroeconomic topics. Alasdair, thank you for being with us today.
That's my pleasure, Brett.
Alasdair, I wanted to begin with some of your bigger picture views on what's been happening in the world since the 2008 crisis. In particular, I'd like you to comment on central bank policies and the resulting impact on global money supply.
A very, very big topic. Well, as I'm sure virtually everybody who has anything to do with finance knows, the Lehman crisis was a major crisis. And immediately after the crisis, prices of everything started falling. I mean, we noticed in the UK, for example, which is where I lived, that you could buy Citroen cars. You could, before you would buy one car, suddenly they were offering one and get one free. I mean, it was that serious. You could buy a Mercedes at a 40% discount. Now that, to my mind, quite simply, is an adjustment in prices for an event which changed the whole pricing structure of the economy. Now, this is something that central bankers don't like. They believe that lower prices are bad for an economy. They think it puts off consumers. So their first reaction to that event was to make unlimited quantities of money available. And you may indeed remember in America, the amount of money that was suddenly made available to the banks was absolutely staggering. I think I totaled it up and ended up with a figure like 13 trillion, which wasn't all drawn on, but my goodness, I mean, compared to the size of the US economy at that time, this was really, really major. Now, since then, the Federal Reserve Board has expanded its balance sheet through QE1, QE2, and more latterly QE3, which is just coming to an end virtually as we speak. And in the process has expanded its monetary base by something like 4 or 5 times. Now, this is important because the dollar is the base money for the rest of the world. It's not just the international unit of accounting. It is the reserve currency for everybody else. And what this means is that when something goes wrong in another currency, then the markets look back to the relationship between that currency and the dollar. So if you like, you end up with a run on the currency going back into the dollars. So we need to look not just at the quantity of dollars in circulation, and by dollars in circulation I mean the amount of base money, or cash if you like, issued by the Fed, but also bank credit, which is the total amount of money, what you used to call M3, but actually M2 is quite close to it. But you need also to look at the same numbers for all the other currencies. And the figure is truly staggering. I can't remember what I came up with, but I think it was something like $158 trillion equivalent. Into that, you've also got to include, and that figure does include, the shadow banking system. Now, this is off-balance sheet bank activities, if you like, mainly to do with securities, securitization. That's 75 trillion on its own. These are huge numbers, and it means that if you look at the structure of the international monetary system, on the pre-Lehman base, which was, I think from memory, something like 750 or 800 billion dollars, the gearing on that is nearly 180 times. Now you can see that with gearing of that order, which would frighten anyone, quite honestly. You can see
by gearing you mean leverage off.
Yes, exactly. Yes. Leverage, if you like, between the big number and the little number. If something goes wrong with the big number, there's not very much of the little number to protect people, if you like. If there's a stampede from the 158 trillion into what was originally less than a trillion, you can see that everybody's rushing to the same thing and there's nothing to hand out. The whole system goes bust. And that is, I'm not saying that the whole system is going to go bust, but I'm saying that this is the fragile state within which we live. This is very important to understand, because if we have another crisis, and I'm sure we'll get on to what that crisis will, could possibly be, but if we have another crisis, anything approaching the Lehman event, then the currencies themselves are probably the biggest risk we have. And I'm particularly interested in this because of my role as head of research at GoldMoney. Obviously, we have customers who own gold, and I look at gold, and obviously gold is very, very important in that event.
And Alasdair, one of the things I think that makes this environment so confusing to me is that as the world continues to paper over global weakness, you've almost got this collision of global weakness itself, let's just call it deflationary forces, colliding with money printing or inflationary forces. And it's led to a little bit of a false stability, for many people viewing it today. They seem to be offsetting each other to some degree. So you've talked a little bit now and written about a potential flight to the U.S. dollar, people moving to the U.S. dollar as a sign that the system is changing and, maybe we're seeing increasing global weakness. I guess the question is, do you expect during the next crisis a flight to the U.S. dollar first, so weakness first, and then inflation later? And if you expect inflation as a result, can you talk through why that would be the case?
That's a very interesting question. We won't know until it happens, but I think the answer is broadly the way you have outlined it has got to be right, because we have a global economy which is always on the brink of a slump. We see that in Japan already. We're seeing it emerging in Europe, and the trade relationship with Russia isn't helping that situation. We see it almost continually in the U.S. as well. And I would just note that in the case of the U.S., the deflator for the GDP number is not nearly sufficient. It's not realistic. The idea that you have a deflator of 1.5 or 2% or whatever it is that they say is completely wrong. The rate of inflation in the States on any measure is considerably greater than that. The point about that is that if you have a larger deflator, then obviously you have got no real economic growth as far as the statisticians are concerned. So the world, if you like, is sort of walking on this tightrope that you rather described, where, if you fall off, you can fall an awful long way. There is a problem, if you like, with expanding money supply as the cure-all for economic problems. In the past, it has worked in the very short term, perhaps, to kick off the next business cycle. But the inherent problem with printing money is that you actually transfer wealth from the people who can least afford it to the people who least need it. And now by that, principally, I'm referring to something called the Cantillon effect. And the Cantillon effect basically says that when you introduce new money into an economy, the people who benefit from it are the people who have it first. After that, as it's spent in the economy, it drives up prices, and the last person to get it is the person who suffers from the debasement most. So in this situation, you can see that bankers benefit and the government benefits, because the government, if you like, has its own agency printing the money, and the bankers are the first to get it. But by the time 80 or 90% of the population get hold of it, they find that its value has gone down. Now this means two things. It means the value of their savings have gone down. The income those savings generate has gone down. It also means, and these people are usually on a fixed salary of some sort, it means that those people have lost purchasing power from their salaries. So what we have had over the last 5-6 years of trying to kickstart all our economies by printing money is that we have impoverished the very people who we require to spend and get the economy going. Now this is a point which is not recognized by mainstream economists, because they always look at the very, very shallow effective policy, and that is, if we can just put more money into the economy and kid everybody that there is more money and it's cheap and all the rest of it, it'll get confidence going and suddenly life will be wonderful. I'm sorry, it's not like that. If it can stimulate very, very quickly, then you might be able to convince people that by some magic things have recovered. But when it doesn't actually work in the first place, then you end up impoverishing everybody and you get no recovery. And I think Japan is the best example of this at the moment. Abenomics is expanding the budget deficit very rapidly, continuing to do so, it's been doing for some considerable time. But now they cannot afford to finance the government deficit out of savings. Why? Because the savers are all retired and they need to spend their savings in order to survive. So the only alternative that the government can come up with is something they invented called Abenomics. And under Abenomics, they have this wonderful idea that they print money to stimulate the economy, when in fact what they are doing is they're printing money to finance the government deficit. Meanwhile, the economy is going to hell in a handbasket. Now that, I think, is a slightly more extreme example of what all the other major central banks are actually doing. So the situation is really quite bizarre. Instead of monetary inflation transferring or translating quite rapidly into price inflation, well, it is translating into price inflation. It's just not hitting those basics which people spend their money on. It's hitting assets rather than consumer goods, if you like. Rather than doing that, things are actually so bad that we haven't even got that effect coming through. And I think that I think tells me that there is only one direction that these economies are going to go, and that is the way Japan is going. Now, under those circumstances, we're going to have, in effect, a deflationary outcome. But it is the job of a central bank, and in fact this is why they were created in the first place, to ensure that deflation never occurs. And they have one tool to ensure that they achieve this objective, and that is printing money. If necessary, helicopter it, I think, as the previous head of the Federal Reserve Board said. That is literally the only tool they have got for trying to get the economy back onto some sort of sustainable path. And my goodness, they will use it. Any sign of deflation, they will use it. So the answer to your question, Brett, is deflation first, very rapidly followed by inflation. Now, whether markets will look through that, see deflation and immediately think, the response is going to be an excess of printing, and therefore the uncertainty shifts, let us say, into bonds because we don't know how they're going to succeed, and into equities, obviously, on the back of the bond market. And perhaps the answer is to hold precious metals in case they don't achieve the objective. To how rapidly that thought process works through, we just don't know at this stage. I would obviously hope, really, because I can't see any other outcome to this, I would hope that all our investors at GoldMoney see the benefits, if you like, to their gold and silver holdings quite rapidly before they're, let's say, spooked into selling them.
Alasdair, in your opinion, what could be the next move for central banks that we're not necessarily anticipating? I mean, we've already got quantitative easing, printing money out of thin air. We've got negative interest rates now in Euroland to some degree, and increasingly we might have banks putting more money into the system and multiplying money through fractional reserve banking system. What do you see, assuming we go into kind of a continued period of weakness or something more severe, what other stealth ways of continuing to expand the money supply do you see out there, or is it just a continuation of those three?
I think it's rather a continuation of the situation we have at the moment. To be fair to the central bankers, they've got themselves into a situation from which there is no obvious escape. And I think they're in the business now of trying not to upset the status quo. And in a sense, the worst thing that can happen to them is to see economic recovery, because they would have to put up interest rates. And then we raise the question, how far can you raise interest rates before toppling the system over? Now, I suspect that the answer to that in America is probably, if you moved it up to 3%, then there would be some people in severe difficulties. But even before you get there, think of the effect on other countries. I mean, what would happen to Italy, for example? What would happen to France? These are heavily indebted nations, both in the public and private sectors, who really cannot take the extra burden of higher interest rates. In other words, we're in a debt trap, really, from which there is no escape. so that's on the one hand. On the other hand, if we do tip into a slump, and I like to call it a slump rather than use the terms deflation, inflation, but if we do tip into an economic slump, which at the moment looks to me to be the greater risk, then there again they've got a problem, because the markets, I think, are going to start thinking two things. Firstly, what's the effects on government deficits? In other words, how much are they going to have to borrow in the markets? And the second thing they'll be thinking is, what's the effect on corporate profitability? And therefore, how should we rate our stocks? So you can see that either way, there's a sort of, it's rather nasty, whichever way of the Y you fall. So I think coming back to your basic question about what one sees in terms of policy, I think really it's all I can say is it's steady as we go, and we just keep our fingers crossed that we neither recover nor go into the slump. Very, very negative approach, but I think if I was a central banker, that's what I would be praying for.
Interesting. So I guess turning our attention then to the gold markets, because I'd like you to expand on why gold can protect investors or precious metals in general from the kind of scenarios you're painting, and maybe some observations about what's going on in the gold market today. There's been a lot of talk of physical gold moving from west to east. Maybe you could just give us a little bit of an overview of the market as you see it today and why gold is uniquely positioned, to help protect.
Well, I think the first thing I must say is that gold throughout history has always been money as far as the human race is concerned. Every time governments have produced a currency of, call it fiat or whatever, it really doesn't matter, but every time they have tried to replace gold or silver as currency, their currency has failed. And that obviously is apart from the ones we have at the moment. But if history is any guide, they will fail. And certainly when you look at what's going on to those currencies and you see the rate at which they're being expanded and the impossibility of the situation, you can see various scenarios where they're almost bound to fail. So gold in that sense is the best money you've got. No government can print it, and it is nobody's counterparty risk. You own gold, it's no one else's risk. And I think that's very, very important. This obviously is a role which central banks in the West would rather not see being used. So they always knock gold, if you like, and proffer their own currencies as the only modern alternative. Now, gold is something that was selected by man in the markets. Paper currencies wasn't. Paper currencies are imposed upon us. Now that's fine, that's all history. But we're now in a situation where if the Western paper currencies face destruction, then what do? Well, the simple answer is you go back to gold. Now, this is not just me saying it. You mentioned the flow of gold from west to east. There is something going on in Asia which the mainstream media have completely missed. And that is the association between Russia, China, and various other states in Asia. This month, 4 other states have joined, and that's India, Pakistan, Iran, and Mongolia. Between all the nations who are direct members of the Shanghai Cooperation Organization, we are now talking over 3 billion people. That is roughly half the Earth's population, slightly less than half. There are other affiliates, as it were, who are likely to join at some stage in the future. Interestingly, this includes Turkey. The point that all these countries have in common is they like gold. They don't like dollars. And China in particular has been building a protective shield of gold round her economy so that she is not dependent on the dollar in any way. So that if the United States government decides to confiscate her treasury holdings, or at least limit her access to them, then she can drive up the price of gold so that she has no financial loss in the exercise. We also have the situation with Russia. Russia is now subject to sanctions from the West. And under those circumstances, I think what a Western economist would recommend the Russians to do would be to preserve her foreign exchange so that she could protect the ruble. Has she done that? No, what she's done is she's run out and she's buying gold, and she's accelerated her gold purchasing program quite significantly. So you can see that these countries, which are do not have the burden of welfare costs, they do not have, well, putting China to one side for a moment, they do not have the burdens of debt that the West have. You can see that these countries are inherently strong economically in a way in which we are not. We are absolutely burdened with debt. And these countries have chosen to go back to gold, partly because, for geopolitical reasons, they want to do away with using the dollar. But I have no doubt at all that gold is going to play some sort of role in international trade in Asia, which is over half the world's population. And incidentally, missing in all this are all the Southeast Asian states. And guess what? The Chinese diaspora dominates those states. I know they're allied with us in NATO and also the Pacific Organized Defense Organization with America, but at heart they are Chinese and they are Asian. So here again, we have over half the world's population are actually acquiring gold. So whether you and I in the West think that Keynes was a wonderful chap for getting rid of gold is actually completely immaterial, because we're now on the decline. We are outnumbered. I mean, the Americans and the Europeans are, what, about 1 billion people, I suppose. So we're outnumbered 3 or 4 to 1 almost. You know, we're not going to call the shots in this. So gold, I think quite simply, on an historic basis and also given the geopolitics of what's going on at the moment, is actually the sensible insurance policy against the systemic risks which I can only see getting worse.
Yeah, I would agree. And do you do any projections for where you could see gold prices going? I know it's all so path dependent on where the world heads, but would you give any guidance in that regard?
Well, I always refuse, I'm afraid, to forecast prices.
That's okay.
For the very simple, I mean, you know, I find when Reuters and so on get on to me, you know, I mean, they want me to guess what it's going to be. I mean, it's actually hopeless. And you know, when I've tried to guess other things in the past, I've got it horribly wrong. And the reason is that we just don't know what the future's going. I mean, you know, I know the direction in which things are moving, but I can't necessarily quantify it, and I know what I should do to protect myself. So, you know, all I can do, I think, is try and help people understand the importance of sound money, which is really what we're talking about, and to open their eyes to the danger of unsound currency. And I think if I can achieve that, then that gives the background for people to take their own decision to protect themselves.
Absolutely. Now, I know you're also a huge advocate of the fact that if you're going to own gold or silver or any other precious metals, that you need to own it physically and outside the system. Can you just talk about why that's so important in the world ahead?
Oh, absolutely. Basically, if the banks go bust, I mean, even though you might have them holding on to it, if you like, as custodians of your gold, I would expect it to be very difficult for anyone to get a liquidator of a bank, or indeed the central bank, if it takes over the management of the bank, to divvy up your gold. We had a very good instance of this, or worrying instance of this, with Cyprus. In the wake of the Cyprus bail-in, there was a lot of panic in Europe about the status of people's large deposits in banks. And money was shifted around from banks with poor balance sheets to banks with better balance sheets, because obviously, you know, with legislation going through in all G20 countries to permit bail-ins as the, if you like, preferred way of dealing with a banking crisis rather than a bail-out, then the status of uninsured deposits gets very, very serious. But it didn't just stop with euros, it also went to gold. So people with unallocated accounts, and an unallocated gold account is just like a deposit account, if you like, a currency deposit account, in that you're a creditor of the bank when the bank goes under. They suddenly realized that they wouldn't have any protection from anyone at all. So they started demanding back their settlement of their unallocated accounts in gold. So much so that ABN AMRO and Rabobank, two large Dutch banks, decided to suspend the facility of paying out their unallocated accounts in gold. Now, that was before they hit the market in, it was 2013, wasn't it? April 2013. And that was a deliberate attempt to get everybody to realize that gold is in a bear market and don't hoard it, as it were, because the strains on the banking system were just becoming too great. So you can see that things happen when you have gold in banks, which really, if what you're doing is insuring yourself against systemic risk, it makes no sense at all to keep your gold in a bank. And furthermore, the other thing I would suggest is that it also makes sense for you to ensure that your gold is vaulted in a different country from where you reside. Now, the reason for that, obviously, it would be obvious to any American who is aware of what President Roosevelt did all those years ago, in 1933, I think it was, where there was the forced redemption of gold to the government at $20.67. It was followed 8 months later by a devaluation of the dollar to $35 an ounce. So obviously, 2 points that come out of that: don't keep your gold in the banks, and the second is, if you've got sufficient to store it in some sort of vaulted arrangement, then make sure that you do it abroad.
And one other question on that, Alasdair. I hear some people, in particular in the U.S., who like gold, own it physically. They own it and they hold it in a safety deposit box in the bank, thinking that provides them a more secure way to own it than an unallocated bank account. I think there's still risk in that. Do you have any comment in that versus the idea of owning it physically in a private vault outside the system altogether?
Yes, I would agree with you. There is risk in that because you have no way of knowing how the bank will behave if there is another banking crisis. It may not be that the bank wants to do you down. It could be that they get a command, if you like, from the central bank, from the Fed, as to how to treat the contents of safe deposit boxes. I mean, there is precedent for this, I'm afraid, and a precedent all over the world. I mean, I'm not saying it will happen again, but what I'm saying is I don't think it would be wise to take the risk.
Right. What about silver? Will you give us just a comment on silver and how you view it relative to gold in this, unfolding story ahead?
Well, silver is a fascinating one. I think, well, there are two elements to this, obviously, and that is that silver is used both as a precious metal. It has, if you like, a sort of, it's a poor man's gold in a sense, but also it has very, very important qualities, which means that there is huge industrial demand for it. It's not just the solar panels, which China is the largest manufacturer in the world for now, but also it's got biocidal qualities, which are really unparalleled, I think, in virtually every other metal. So you've got these sort of two elements when you look at the demand for it. Now, I would expect that if the price of silver rises along with gold, let's assume that there's a new bull market in gold. Silver is roughly twice as volatile as gold. So if gold goes up, say, 30%, silver will go up 60%. There will be at some stage, I think, an effect on industrial demand. Now, quite where that comes in, I don't know. But I would think that if you see silver go very much over $50, then industrial demand is going to start falling off because products will be priced out of the market. And instead, what we will be relying on is increased investment interest, or if you like, increased investment from people trying to protect themselves from unsound money to drive the price. Whichever way, you don't have the stocks that you have with gold. If you do get a collapse, then what I would see is the gold-silver ratio, which is almost 70 at the moment, which is very, very high, moving back towards the level which was originally identified by Newton, I think, Sir Isaac Newton. And he reckoned it was something, I think he said something like between 14 and 16 ounces of silver to 1 ounce of gold. I think it would be a very bold person to say we get back to that relationship, but I would certainly see the relationship changing and coming back down to, say, the 30s and possibly the 20s. That's a very, very long-term view, and it's a view which I would qualify in that I think it would take a financial crisis to get it to that level.
Yeah, well, let's hope we don't see it, but as far as the crisis, but it looks like all paths are on a pretty dangerous trajectory ahead. Alasdair, I wanted to thank you for your time today. We really appreciate it. Can you tell our listeners how they can receive your commentary and learn more about your efforts at GoldMoney?
Yes, of course. GoldMoney is based in the United Kingdom. I think about half our customers are American, which I think is probably mainly your audience, Brett. If you go to goldmoney.com, you can sort of navigate from there. There is a research section. I'm head of research there. I write weekly, so I think you can subscribe to get GoldMoney's research. So you get that weekly, and I also do a market report weekly as well, which goes into really, sort of a bit more of the actual trading, if you like, than charts. People throw charts, and I think there are quite enough people doing charts without me adding to that. So I try and work out actually what's going on between categories such as the banks, the managed money category, the producers, and so on and so forth.
Well, great. Well, thank you again.